Hey friends, it's Iggy here from the Investing Iguana. Let's walk through something big that just happened on SGX and why it could change how we build a Singapore portfolio. Most folks obsess over the STI, right? The 30 blue chip names. But SGX just launched 2 indices that track the next tier of 50 companies. These could offer better yields and, in the right cycles, stronger returns. Today we'll go section by section through my Substack piece so it all maps cleanly for you. First, a quick promise. By the end, you'll know what the new iEdge Singapore Next 50 indices are, how they differ from STI when they tend to shine, and how to plug them into a pragmatic Singapore portfolio. If you're new here, I've spent years breaking down Singapore investing so you don't have to stress. Let's dive in. So, what did SGX launch and why should we care? On 22 September 2025, SGX rolled out 2 versions, the iEdge Singapore Next 50, which is market cap weighted, and a liquidity weighted version that gives more weight to the names that trade more actively. Both track the 50 largest and most liquid companies outside the STI. In plain English, it's a rule-based way to capture the up-and-comers, that mid-cap layer that's often overlooked but full of income and growth. Alright, that brings us to the first section in the article, understanding the next 50 more than just numbers. Let's break this down together. The indices use clear entry rules. Think minimum market cap of $100 million, at least $100,000 daily trading turnover, and a 15% free float. From that pool, the largest 50 by market cap are picked. Each stock is capped at 5%, so no single name dominates. It rebalances quarterly, which keeps it fresh and responsive. Now the 2 versions. The market cap one is straightforward. Bigger companies get more weight. The liquidity one tilts to what's getting traded more. Why does that matter? If the market starts paying attention to a stock and volume jumps, the liquidity index reflects that interest faster. Honestly, I used to get tripped up by this too. Market cap feels stable, liquidity feels active. Both serve a purpose. Which matters more to you, size or tradability? The article then moves to this point. Composition is where the next 50 tells a different story from the STI. And this is where it gets interesting for Singapore investors like us. Next section, REIT dominance, the new Singapore story. Imagine a quick table in your head. STI has heavy banks. The next 50 has heavy REITs. In the market cap version, REITs are about 45%. In the liquidity version, they're roughly 34.4%. The STI, around 10% in REITs. What does that mean for us? If we want more income and broader property exposure, industrial, office, data centers, healthcare, hospitality, the next 50 does that in one swipe. Names you'll recognize: Keppel REIT, Suntec REIT, Parkway Life REIT, NTT DC REIT, Capitaland, Ascot Trust, Ames APAC REIT, and more. And this structure helps explain why the latest dividend yield estimate for the next 50 sits higher than STI, about 5.85% versus 4.48% on STI. So, if income is a key objective, this basket aligns well. But ask, am I comfortable with the property cycle and rate sensitivity that comes with it? Now the performance section. Performance reality check. When mid-caps shine. Here's where people get surprised. Over 10 years, STI's average annual return is higher. But in specific periods, the next 50 pulled ahead by a lot. Think 2017, 2020, and then again from 2022 through 2025, year to date. Why? When markets recover or when rates favor income plays, the REIT-heavy structure tends to catch a bid. It's like having a spring in the portfolio that compresses during rate hikes and releases as cuts come through. Imagine the snapshot table. Years like 2017, STI about 16.5%, next 50 about 46%. 2020, STI negative, next 50 positive. 2025, YTD, STI around 19%, while next 50 is mid-20s. So what does that really mean for us? If the macro sets up for easing or if REITs re-rate, this sleeve can add real juice to overall returns. But it also swings more with rates, so position sizing matters. Next section, strategic investment implications for Singapore investors. Should we add next 50 exposure? Here's how I frame it. If higher income appeals, if we want to diversify away from the STI's bank concentration, and if we believe some of these mid-caps can graduate into STI over time, then yes, this is a sensible complement, not a replacement. A complement. Picture a simple suitability checklist. If income matters, tick. If diversification away from banks matters, tick. If medium risk tolerance is fine, tick. If we like the idea of future blue chips, tick. One caveat, long-run averages still favor STI, so keep STI as core. The next 50 is the satellite that adds yield and selective upside. Now let's go into practical implementation strategies. Here's how I'd set this up. Use a core satellite approach. Keep STI as the core because it's liquid, stable, and broad. Add 10-20%. Next up, 50 is the satellite for income and diversification. If the goal is income, go a little higher, say 20-30%, but only if the portfolio can handle REIT-heavy swings. Tactically, raise the weight during rate cut cycles and ease off if rate hikes resume. I know this part can feel mechanical, but think of it like adjusting aircon. Nudge up or down based on the temperature of rates. Right about halfway, quick plug. By the way, if you want all the reference tables, checklists, and the full written version, everything's on Substack. The link's just below. It's the best place to get the charts and the step-by-step frameworks we're discussing here. Next up, risk management and portfolio considerations. Let's keep this simple. Interest rate risk is the big one because of the REIT tilt. Property cycle risk is tied to rents, occupancy, and refinancing. Liquidity risk. Mid-caps don't always trade as tight as blue chips. Concentration risk. REITs can bunch. So what do? Cap the next 50 allocation to say 25% max of Singapore equities. Keep STI for ballast. Dollar cost average to ease entry risk. And stick to the plan when the cycle turns noisy. Finally, the verdict. Measured optimism with strategic focus. Here's the bottom line from the article, said plainly. The iEdge Singapore Next 50 is a real addition to our toolkit. Higher yield, broader sector mix, and the potential to outperform in the right macro. But it's not a silver bullet. Keep STI as core. Use the Next 50 as a smart satellite. For most Singapore investors, a 10-20% allocation hits the sweet spot. And keep an eye on the rate cycle. That's the key driver for this sleeve. Here's my honest take. In my own Singapore sleeve, STI stays as the anchor because the banks and the big caps still set the tone. But I like carving out a deliberate chunk, about 15%, for the next 50 to boost yield and reduce single sector concentration. If I could give you one thing to remember, it's this. The next 50 is a lever. Pull it more when rates are falling and income assets are in favor. Ease off when financing costs rise. Simple, rules-based moves beat guesswork. So, if you're planning your next move, here's what I'd keep in mind. Keep STI as core, add the next 50 as a strategic satellite, and let the rate cycle guide your tilt. What are you looking at this month? Drop a comment. I read everything and replied to as many as possible. If this was helpful and you want early access to my Singapore market notes, members-only checklists, and portfolio clinics, join the premium community on Substack. It's where we go deeper together with less noise and more signal. And if you want the context on why Singapore's market has been stronger this year, watch the next video on STI drivers and the bank cycle. I'll see you there.